On your screen right now, imagine three completely different stock charts. The first is a tiny gym equipment retailer that suddenly decides it wants to build AI robots and hold millions of dollars worth of crypto-style tokens on its balance sheet. The second is a biotech name where one experimental drug is either going to change patients' lives and make investors rich, or wipe out most of the equity. And the third is a once famous grocery store brand, a former Wall Street darling, that has crashed so hard it now trades as a penny stock and is fighting for survival. This is the world of extreme penny stock stories. And today, we're going to break down all three. Welcome back to the channel. This is Penny Stock Pulse. In this video, we're going deep into three very different cases: a chaotic pivot to everything story, a binary biotech bet, and a fallen angel consumer brand that everyone thought was the future just a few years ago. By the end of this video, you'll understand what these businesses actually do, what's gone right, what's gone very wrong, and what kind of risk you'd really be taking if you decided to research them further. Before we get into it, I need to be absolutely clear. I am not a financial advisor. Nothing in this video is financial advice, and nothing here is a recommendation to buy or sell any stock. Penny stocks are extremely risky. These names are volatile enough that you can lose a large portion, or even all, of your investment very quickly. Always do your own research, understand your financial situation and risk tolerance, and never invest money you cannot afford to lose. All of the information in this video is based on public sources available at the time of recording and will change over time. Alright, with that out of the way, let's start with the most chaotic story of the three. Our first company looks almost boring if you only skim the description. It's an online retailer of gym and fitness equipment in Australia. Think racks, benches, dumbbells, barbells, the kind of stuff you'd see in a commercial gym or a serious home setup. It's a simple, understandable business in a world that's more health conscious than ever. But if you stop there, you miss the part that makes this stock completely insane. Because this little fitness retailer decided it doesn't just want to sell equipment anymore. It wants to become a player in two of the loudest, riskiest themes in the market: AI robotics and digital assets. On the tech side, management launched a robotics division aimed at AI-driven robotic systems. On the crypto side, the company moved into managing a treasury of digital tokens, including a huge pile of so-called PUMP tokens and stablecoin-linked financing. Yes, you heard that right. A gym equipment company loading up on meme-style tokens and stablecoins while trying to rebrand itself as a robotics and AI play. At the same time, they announced a 10-cent per share dividend and a multi-million-dollar share buyback program. Those are the kind of moves you usually see from boring blue-chip companies that throw off predictable cash flow. Not from a tiny, speculative stock trying to reinvent itself in two totally different directions at once. Now, when you look at the price action, it almost doesn't look real. Over the last year, on a split-adjusted basis, this stock has traded in a range that runs from well under $1 to the high hundreds of dollars per share. A big part of that is a reverse split, which multiplied the share price by shrinking the share count. So if you pull up a normal chart on your broker and you don't see those huge numbers, that's why. The point isn't the exact price. The point is how violently this thing moves. Here's the twist that makes it even more confusing. Underneath all of that noise, the old core business is actually improving. Recent results show revenue from the fitness equipment side growing at a double-digit rate, and the company has slashed its net loss by more than 90% through cost cutting. If you looked only at that part, you'd see a small retailer that's slowly tightening up and moving closer to broke, but the stock isn't trading on small, improving retailer. The market is trading it as a leveraged bet on the pivot. The robotics division, the digital tokens, the stablecoin financing, and this whole let's become a next-gen tech company narrative. So what are you really betting on with FTEL Corporation, ticker FTEL? You're not just betting on people buying gym equipment. You're betting on a management team that wants to jump from a niche retail business into AI, robots, and crypto at the same time, without blowing up the company in the process. If they somehow execute this correctly, the upside could be enormous. If they misstep, shareholders could be left holding the bag. Our second company couldn't be more different. Instead of robots and tokens, this one lives and dies by one thing: a single experimental drug. This is Jasper Therapeutics, ticker JSPR, a clinical stage biotech focused on mast cell-driven diseases. These are conditions where a certain type of immune cell, the mast cell, goes into overdrive and causes chronic, sometimes brutal symptoms. Think of people dealing with severe chronic hives or other inflammatory conditions that can destroy quality of life and don't respond well to existing treatments. JSPR's entire story revolves around one lead drug, briquilimab. It's a monoclonal antibody designed to target the biology behind these mast cell-driven diseases. Early trial data, especially in conditions like chronic urticaria, has been encouraging. Not enough to declare victory, but enough to get serious people in the biotech world paying attention. Like almost every company at this stage, JSPR is not profitable. It burns cash every quarter to run trials, pay staff, and keep the lights on. The good news is that it currently has over $50 million in cash and believes it has enough runway to fund operations into the middle of 2026, especially after a recent equity raise. The bad news is that, just like most early biotech companies, it will almost certainly need more money down the road, and that usually means more dilution. The most interesting part of the JSPR story isn't on the income statement, it's in the shareholder list. Roughly 80% of this company's stock is owned by big institutional investors, hedge funds, biotech specialists, pension money, and major asset managers. These are investors who live and breathe drug development. They've studied the mechanism of action, the trial designs, the competition, and the potential addressable market, and they've decided this is a bet worth taking. But this creates a unique dynamic I like to call the institutional trap. When funds own 80% of a stock, liquidity can dry up. They can't all sell at once without crashing the price. They are essentially locked in the room until the clinical data comes out. And remember, this is still biotech. Nothing here is guaranteed. JSPR has already run into issues in some programs, including anomalous trial results that forced them to cut back and refocus the pipeline around briquilimab. That was painful, but it also concentrated the entire company on one core program. So how do you think about JSPR? In simple terms, this is a binary science bet. If briquilimab continues to deliver strong, clean data in larger, well-controlled trials, and if JSPR can keep funding itself without completely crushing shareholders, the upside can be huge. If the drug fails, or serious safety problems appear, or the company runs out of money, the stock can collapse. You are not buying a diversified pharma empire here. You are essentially buying a single, high-risk research project. Our third company is probably sitting in a freezer somewhere in your local grocery store right now. This is Beyond Meat, ticker BYND, the plant-based meat company that was once one of the hottest IPOs on the market. A few years ago, this stock was trading near $240 per share. It was on magazine covers, on fast food menus, and in pretty much every conversation about the future of food. Fast forward to today, and Beyond Meat is a penny stock. The share price has crashed more than 90% from its peak and more than 70% in just the last year. At times, it has traded below $1, putting it at risk of being delisted from the Nasdaq if it can't regain and hold a higher price. So what went wrong? A few big things hit at once. Demand for processed plant-based meat turned out to be weaker and less sticky than the early hype suggested. Sales have declined, and the company has reported weak consumer demand in some of its own communications. At the same time, Beyond Meat has struggled to turn its brand power into sustainable profits. It's been burning cash and carrying a large debt load. To deal with that, the company executed a massive debt exchange, trading old 0% convertible notes for new, higher interest debt and a huge number of new shares. That move reduced some of the debt burden, but it heavily diluted existing shareholders and raised serious questions about long-term viability. On top of all of this, multiple law firms have announced investigations into possible securities law violations and past disclosures. Wall Street analysts who once had very high expectations for Beyond Meat have cut their price targets dramatically. Some major firms now have targets around the $1 area, and the overall analyst view has shifted into sell and strong sell territory. Given that backdrop, you might wonder why this stock is still so heavily traded. The answer comes down to brand and speculation. The Beyond Meat name is still incredibly well known. The products are still visible in stores. That brand equity hasn't completely disappeared. And because the stock is so beaten down and so heavily shorted, any hint of good news, or even just social media buzz, can trigger sharp, violent rallies as shorts rush to cover. I like to call this the coiled spring effect. When everyone is betting on a company to die, even a small sign of life can cause the stock to explode upwards temporarily. So what are you really doing if you buy Beyond Meat down here? You're not buying the sure thing future of food story that people thought they were. Getting at the IPO, you're making a turnaround bet on a distressed brand. You're hoping that cost cuts, a strategic reset, and brand power are enough to overcome weak demand, dilution, and years of value destruction. Let's zoom out and put all three side by side. FTEL, ticker FTEL, is the chaotic transformer. A small but improving fitness retailer underneath, wrapped in a wild pivot into AI robotics, meme-style tokens, and stablecoins. Here, you're betting on a management team that's trying to turn a niche business into a high-tech story. With extreme volatility as the price of admission, JSPR Therapeutics, ticker JSPR, is the binary biotech. This is a one-drug thesis built around briquilimab and mast cell-driven diseases, backed heavily by institutional investors. Here, you're effectively betting on the outcome of clinical trials and the company's ability to finance itself through the finish line. Beyond Meat, ticker BYND, is the fallen angel, a once hyped, globally recognized brand that has imploded into penny stock territory and is now trying to engineer a turnaround while dealing with shrinking sales, heavy dilution, and skeptical consumers and investors. Three completely different stories. Three completely different ways to lose money, or potentially make a lot of it. Before we wrap up, let's talk quickly about the kinds of catalysts you'd want to watch if you add any of these to your watch list. For FTEL, keep an eye on their future filings and press releases. You want to see whether the robotics plans and those big digital asset announcements actually turn into real assets, contracts, and cash flow, or whether they quietly disappear. For JSPR, the big catalysts are clinical data and cash runway. Watch for updates on new trial results for briquilimab and any announcements about financing, partnerships, or changes to how long their cash is expected to last. For Beyond Meat, focus on quarterly earnings and short interest. Earnings will tell you whether the turnaround plan is actually stabilizing the business. Short interest data, which is updated regularly, can give you a sense of how crowded the bearish trade is and how much fuel there might be for another squeeze if sentiment flips, even temporarily. The real question is, which risk profile comes closest to matching your own? Do you gravitate toward the chaotic innovator, the all-or-nothing science bet, or the high-profile turnaround that everyone has an opinion about? Let me know in the comments which of these, if any, you would consider researching further, and why. And remember, this video is just the starting point. If any of these names interest you, your real work starts now. Read the latest financial reports. Listen to earnings calls. Look at cash burn, dilution, and debt. Study the competitive landscape. And be brutally honest with yourself about how much risk you're actually willing to take. If you found this deep dive valuable, please tap that like button, subscribe to the channel for more research-first penny stock breakdowns, and ring the notification bell so you never miss a future video. Thanks for watching, and I'll see you in the next one.